All right, welcome to this explainer. Today, we're unpacking a pretty dense, data-heavy Q2 2026 earnings presentation to reveal the powerful momentum driving this enterprise's success right now. If you've been following corporate software and tech performance, you know exactly how critical these quarterly updates are for figuring out where the market is actually heading. So today, we're not just staring at numbers on a spreadsheet. We're examining the flywheel effect. You know, how revenue, cash flow, product innovation, and strategic capital allocation all spin together to create this aggressive, compounded growth. But before we get totally lost in the sheer size of the financial numbers, it's really important to set the stage for how all these different business units connect. Because this isn't just some random collection of companies. It's a precisely engineered ecosystem of application software, network software, and technology-enabled products, all feeding into one centralized growth strategy. So here's our roadmap for today. We'll hit the Q2 2026 enterprise highlights first, followed by the software segments and technology-enabled products. Then we'll dive into building AI momentum, check out their disciplined capital allocation, and wrap up with the upgraded FY 2026 guidance. Let's get into it. Starting with Section 1, Q2 2026 enterprise highlights, hitting the ground running. We're starting right at the top of the momentum flywheel by looking at the pure scale of the results this quarter. This is where the overall health of the business is measured. And spoiler alert, the indicators here are universally strong. So, total revenue growth? It hit a really solid positive 9%. And we aren't talking about a small base here. That climb represents a jump to over $2.1 billion for just the second quarter alone. Even more impressively, organic revenue grew by 5%, while their strategic M&A activities pitched in another 3%. It's a beautifully balanced approach to top-line expansion. And their cash generation is just as wild. Q2 free cash flow reached a highly robust $447 million, which is an 11% increase. But when you zoom out and look at the bigger picture, that quarterly performance pushes their trailing 12-month free cash flow to an absolutely massive $2.56 billion. That's an 18% compound annual growth rate over 3 years. That kind of cash generation is quite literally the bedrock of a momentum flywheel. Wrapping up the top-level highlights, diluted earnings per share grew by 10% to $5.38. Now, this is a vital metric because it proves that the 9% top-line growth we just talked about actually isn't being lost to ballooning expenses. It is successfully making its way to the bottom line to reward shareholders. Plus, their core EBITDA margins remained incredibly healthy at 38.6%. Moving to Section 2, the software segments, driving the core engine. The crucial point here is understanding exactly where these big numbers are coming from. I mean, a massive enterprise doesn't just accidentally generate $2 billion a quarter. So let's examine their primary growth engines, the application and network software segments. Application software is absolutely the heavyweight champion of the portfolio. Bringing in $1.18 billion in revenue, it totally dwarfs the other two segments. Technology-enabled products sits in the middle with $497 million, while network software delivered $431 million. Let's peel back the layers on that massive application software slice first. Inside application software, we are seeing some really aggressive strategic launches. Take Aderant, for example. They had a stellar quarter by launching first-generation AI agents specifically focused on collections and billing appeals. Meanwhile, heavy hitters like Deltek showed serious strength in the private sector while keeping things stable in government contracting. Rounding it out, Vertafore kept growing its annual recurring revenue, and CentralReach successfully hit its year-one revenue and EBITDA targets right on the nose. It's just a great story of broad-based, highly reliable execution. Then on the network software side, total revenue shot up by an impressive 12%. We're seeing real digital freight momentum with DAT, while Construct Connect is seeing massive adoption of its AI takeoff solution. Add in specialized innovations from Foundry pushing forward with Smart Roto, and Subsplash performing incredibly well by expanding their AI capabilities. You've got a segment firing on all cylinders. All right, Section 3, Technology-Enabled Products, Precision and Growth. Shifting gears from the software side, we need to look at the physical and cloud-integrated products that make up the third pillar of their business. This segment definitely requires a different kind of operational excellence. And this segment quietly delivered a really solid 7% organic growth. NDI had an outstanding quarter with their precision measurement solutions, while Neptune saw continued cloud adoption. A major standout was Verathon's clinical execution, heavily driven by their single-use medical offerings, like the GlideScope and their new cystoscopes. Across the board, from CVO to FMI, Physical precision is proving to be a highly reliable growth lever for them. Section 4, building AI momentum, the secret sauce. So, how on earth are all these different segments accelerating their growth at the exact same time? Well, while every market is different, there is a common thread running through this entire portfolio that is completely turbocharging their product value. We keep seeing this term agentic releases popping up all over their business units, and it's absolutely critical to understand. This means they aren't just slapping a basic passive chatbot onto their software and calling it a day. No way. They are deploying functional, deeply integrated AI agents that actually take direct action to do real work for the end user. It's a highly active rather than passive approach to artificial intelligence. And they are aggressively weaving this functional AI into some highly specialized industries. Just looking at the breakdown, Adherent has agents actively working on legal billing appeals and time management. Vertafore has launched 6 unique agents on their platform. ProCare is using AI to actually forecast enrollment for childcare centers. And Construct Connect is using it to automate complex construction takeoffs. This is AI acting as a tangible productivity multiplier, deployed widely across the entire portfolio. So, generating these massive cash flows and driving all this organic momentum naturally leads to a pretty incredible problem to have. When your enterprise has over $5 billion in annual capacity for capital deployment, sitting still is simply not an option. Every single dollar has to be put to work. Which brings us to Section 5, disciplined capital allocation, putting cash to work. Let's see how they translate that massive cash reserve into aggressive, yet highly sustainable shareholder value. Their approach here is incredibly disciplined, but also super active. They exited the second quarter with a totally manageable 3.4 times net debt to EBITDA ratio. In Q2 alone, they aggressively repurchased 3.6 million shares for $1.2 billion. That brings their program total to 9 million shares retired for $3.2 billion. Think about that. They've literally bought back more than 8% of their total outstanding shares. On top of that, they're actively managing the portfolio, divesting non-core assets like the Indicor instrumentation businesses for $1.4 billion. That perfectly positions them for an M&A environment they expect to be highly attractive. And finally, Section 6, upgraded FY 2026 guidance, the road ahead. All of this past quarter's success, the deep AI integration, the disciplined balance sheet, it all feeds back into the momentum flywheel to shape the future outlook. And as you'd probably expect, these strong Q2 results mean they are raising the bar. Total revenue expectations shifted from approximately 8% to a highly confident 8% plus. Organic revenue guidance tightened upward from a range of 5 to 6%, up to a solid target of approximately 6%. And honestly, most importantly for investors, the adjusted earnings per share guidance was meaningfully raised to between $22.15 and $22.30. So as we wrap up this explainer, you've got the undeniable financial health, you've got the massive reduction of outstanding shares, and honestly, most importantly, you've got this widespread deployment of active agentic AI technology. It really leaves us with a fascinating prospect. They've got the capital, they've got the products, and they clearly have the technological edge. So I leave you with this. As AI stops being just a cool novelty and becomes the literal core engine of corporate software productivity, just how fast can a disciplined machine like this momentum flywheel truly spin in the coming years? Thanks for tuning into this explainer, and as always, keep questioning the data.